Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. AI squeezes, macro shifts, and the trillion-dollar tech battle. This video presents a direct informational narration of the source document. So the source document outlines a market environment right now that is basically a massive tug of war. On one side, sweeping macroeconomic data setting the broad strokes for the global economy. And on the other, some of the most high-stakes, dramatic, micro-level stock battles we've seen in recent memory. If you're wondering how cooling inflation metrics are directly colliding with billion-dollar short squeezes in the AI sector, well, we're going to break it all down. Okay, let's dive right into this truly explosive number, 454%. And no, that is not a long-term projection. That is the actual staggering second quarter revenue growth figure from a heavily shorted AI stock that the source document examines today. When you've got growth metrics that astronomical crashing into a massive wall of bearish bets, the resulting volatility is, frankly, historic. The stakes right now are incredibly high, and the market is merciless if you're caught on the wrong side of the trade. To make sense of all this market chaos, here is our roadmap. First, we'll look at macro data and the Fed outlook. Then we'll check in on the semiconductor sector, unpack the epic AI short squeeze, analyze Michael Burry's costly bear bet, and finally, look at how global capital is chasing AI growth. Part 1. Macro data and the Fed outlook. The weather report. Let's look at the broader economic environment. So the recent US CPI data for July came in exactly as expected, showing just a very mild 0.2% month-over-month increase in core inflation. Those severe energy price shocks that were causing so much panic, they are continuing to fade. Before this CPI data dropped, traders were pricing in a 48.4% probability of a rate hike at the September Fed meeting. But immediately after that data showed inflation cooling, that probability quickly dropped to 42.1%. This fading threat of aggressive tightening has created a distinct risk-on environment, pushing the VIX volatility index down to a 7-month low. The market is definitely breathing a sigh of relief. What's absolutely crucial here is how the major institutional players are interpreting this. Top-tier institutions like JP Morgan and Goldman Sachs are essentially reaching a consensus. They believe the Fed is going to stay put for the second half of the year. Why? Well, because the market currently features extremely high leverage. Even a small symbolic rate hike risks triggering a violent repricing of assets. On top of that, they argue that the relatively high treasury yields we're currently seeing are effectively doing the Fed's tightening work for them. So from a macro perspective, the need for further rate hikes is fading fast. Moving on to part 2, the semiconductor sector at a crossroads, testing the terrain. With the macro environment looking stable, the market is undergoing intense consolidation. It's kind of like a boxer pulling a punch back, gathering energy before deciding exactly where to strike next. The broader S&P 500 index has been consolidating just below the 7,800 level. It's basically missing the crutches of new macroeconomic agreements or massive earnings beats that pushed it up previously, so it's relying on sector rotation to stay afloat while waiting for new catalysts. Meanwhile, the critical PHLX semiconductor index, the SOX, is directly testing its 50-day moving average resistance. This is literally a make-or-break technical level. If it's rejected, this recent rally is just a temporary bounce in a downward trend. But if it breaks through and holds, it signals a major trend reversal. Which brings us to part 3, the epic AI short squeeze, the battlefield. Beneath the surface of these broad indices, explosive individual stock battles are taking place. This is where the real drama unfolded, specifically with the intense short squeezes involving companies like CWIV and NBS. To understand why this squeeze happened, we really have to look at the bait. Take a look at CWIV's fundamentals. On the surface, things look great. They have $14 billion in new orders. But dig a little deeper and you see massive cash burn and depreciation costs. They only hold $5.552 billion in cash against a staggering $72.05 billion in total debt. Add the fact that company executives were frequently selling their shares, and it's easy to see exactly why short sellers aggressively targeted the stock, betting heavily that it would crash. The derivatives market became overwhelmingly concentrated with these bearish bets, setting the stage perfectly for a violent counter-trend short squeeze. But the situation with NBS was even more extreme. Short sellers fully expected the usual delays and a capital return cycle of 2 to 3 years for their massive infrastructure builds. However, NBS revealed that their capital return cycle has actually shortened dramatically, down to just 1 year and 10 months. Paired with that mind-bending 454% revenue growth we mentioned earlier, these fundamentals simply blew the bearish thesis out of the water. This massive disconnect between what the short sellers expected and the company's reality is what sparked an absolutely epic squeeze.
Let's move to part 4, Michael Burry's costly bear bet, the clash of theses. This introduces a fascinating character-driven finance segment of the source document, Michael Burry's high-profile and ultimately very costly bear bet against the AI hardware sector.
Let's break down the opposing forces here neutrally. On one side, we have Burry's bear case. He argued that the current AI rally is being fueled by 2008-style financial engineering, pointing to circular, highly leveraged funding chains that artificially inflate sales numbers. On the flip side, we have the bull reality currently playing out in the market. Wall Street giants are launching hundreds of billions of dollars in AI funding, and they aren't doing it blindly. They're doing it because they view it as a highly priceable, underwritable risk. They are seeing very real, tangible demand. And this brilliantly illustrates one of the core flaws in the immediate bearish argument, which relies on the idea that these expensive GPUs only have an economic lifespan of 2 to 3 years. The actual operating data contradicts this entirely. NVIDIA A100 GPUs, which launched back in 2020, were originally contracted through 2026, but now those contracts are being extended out to 2029. Once those initial depreciation costs are covered, that extended lifespan represents a highly profitable, pure margin second life for the hardware. So, what actually happened mechanically to this trade? Well, Burry established a massive naked short position, meaning he bet directly against the stock without holding any underlying safety net when it was right around $212. He avoided buying standard put options because the implied volatility was astronomically high, over 100%, which made those options incredibly expensive. When the stock price violently squeezed up to $260 on the back of those strong fundamentals, it created a massive, immediate pressure cooker. The result was a brutal chain reaction of short seller liquidations, forcing bears to buy back the stock at huge losses, which of course just drove the price even higher. Finally, part 5, global capital chases AI growth, the nation-state level. When we zoom out from these individual traders, where is the heavy institutional money actually going? Directly into AI infrastructure. Just consider the sheer scale of the capital backing this AI growth. Norway's sovereign wealth fund posted an enormous profit of over $184 billion in the first half of the year. This was heavily driven by allocating 40% of their portfolio to U.S. stocks, specifically targeting AI leaders. They even disclosed a 0.05% stake in SpaceX, valuing that slice alone at $1.2 billion. Meanwhile, Singapore's sovereign wealth fund, Temasek, is actively planning direct investments into undervalued memory chip makers like Samsung and SK Hynix. This is massive, global institutional buying power completely validating the hardware demand. To really hammer home how this AI narrative is redefining traditional companies, consider this striking quote from Elon Musk. He stated that SpaceX's AI revenue will actually surpass its traditional rocket and new businesses as early as September, projecting that in 5 years, AI will account for 99% of SpaceX's valuation. With plans to build a massive 10-gigawatt compute center by next year, SpaceX is effectively transforming into an AI infrastructure entity. Which leaves us with the ultimate question highlighted by the source text. Is the market pricing in a new industrial revolution or repeating the over-leveraged mistakes of the past? On one side, sovereign wealth funds and tech giants are pouring hundreds of billions of dollars into AI, acting as though we are at the dawn of a new era. On the other side, prominent bears are warning of circular funding and extreme leverage reminiscent of past financial crises. As the macro data continues to shift and these individual stock battles rage on, it remains to be seen which side of history this massive capital inflow will ultimately fall on.